Welcome to RBC's Markets in Motion podcast, recorded March 30th, 2026. I'm Lori Calvasina, head of US equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know: first, the tactical indicators we've been tracking to gauge when equity investor fears may have gone too far continue to show signs of significant deterioration, but are not yet pointing to extreme fear, suggesting more downside in stocks is possible near term. Second, other things that jump out include new stress tests on our valuation and earnings model, the latest C-suite tone, the signals from our US GDP model for the S&P if consensus forecasts start to erode, and evidence of de-risking in equities in the latest flow data. If you'd like to hear more, here's another 5 minutes. Takeaway number 1. The tactical indicators are still not sending a hold your nose and buy signal. Investor sentiment does remain bearish, but still isn't back to the 22 or 25 lows. As of March 26, net bulls on the weekly AAII survey were minus 17.7% on the weekly update and minus 14.1% on the 4-week average. The latter remains between one standard deviation and two standard deviations below the average. Longer term, we believe this remains good news for stocks, as the 4-week average is at a level that's been followed by a gain of 15% in the S&P on a 12-month forward basis in the past. As of Friday's close, however, the S&P 500 was just down 8.7% from its late January high, approaching the outer edge of what we'd consider to be a Tier 1 garden variety pullback, 5 to 10% on our Tiers of Fear framework. If we do breach 10% on the drawdown, an eventual move into Tier 2 growth scare territory, a decline of 14 to 20% versus the January peak, also seems possible for the S&P. In that case, we'd be on the lookout for our AAII indicator to fall to more than two standard deviations below average on that 4-week average, which we saw back in late 2022, the spring of 25, and during the GFC. Additionally, small caps look cheap, but may not be cheap enough just yet. As of Thursday's close, the bottom-up FY2 market cap weighted median PE for the Russell 2000 had fallen to 14.98 times, slightly below the long-term average of 15.2, but not yet back to the lows of 2022, 23, and 25, when it fell slightly below 13 times. This is important because small caps are commonly viewed as the most cyclical part of the U.S. equity market. Additionally, in recent years, small cap performance has also become closely linked to investor views on the path of the Fed policy rate, where many have recently had to price out anticipated cuts for 26. And finally, the bottom-up S&P 500 forward NTM PE next 12 months is also falling rapidly. As of Thursday's close, this flavor of PE had fallen to 21 times, slightly above its own long-term average of 18.5, but well below the highs of last fall when it hit 28 times. While it wasn't a helpful bottoming signal in 2023 or 2025, back in 2022, this indicator did fall back down to average, helping to mark the low in the broader market. We've been asked what it could take to get the S&P 500 from a Tier 1 garden variety pullback, a move 5 to 10% below peak, into Tier 2 growth scare drawdown territory, which again is 14 to 20% below peak, roughly 5,600 to 6,000 in today's pricing. Our review of the other growth scares that have occurred in the aftermath of the GFC, which were 2010, 2011, 2015, 16, 2018, and 2025, suggests these types of pullbacks have involved genuine fear of a recession starting to emerge, in some cases involving an unfamiliar challenge that's not well understood and seen as potentially getting out of control. Most of the investors we spoke with last week have not been concerned about a significant growth shock in the U.S. emanating from the conflict in Iran, and have expected the war to be over soon, though doubts on the latter in particular grew as the week wore on. It's not clear to us what investors can tolerate in terms of the duration of the conflict. Client comments last week were generally that they expected 1 to a few more weeks, with one telling us a few more months. But if recession or severe domestic growth shock fears start to emerge in a serious way, it could be enough to pull the S&P 500 into Tier 2 growth scare territory short term. Let's move on to takeaway number 2. What else jumped out in the big picture work? First, we're stressing our stress tests a little bit more. Last week, we updated the stress test we've been using with our valuation and earnings model, which was one of the most constructive models in our toolkit ahead of the war. For our main PE projection, we took our inflation assumption up to 4% and our 10-year yield assumption up to 5%, while keeping Fed funds flat. We now look at 5 flavors of earnings, ranging from sticking with the current bottom-up consensus at the high end to 10% contraction versus 25% at the low end. The fair value outputs for the S&P range from 7,500 at the high end to a little more than 5,700 at the low end. Second, we continue to track the C-suite's tone. Several investors asked us last week when any cuts to earnings forecasts might be coming due to the war in terms of timing. We pointed out that the continued climb in bottom-up consensus S&P 500 EPS for 2026, which now tracks at 323, has been driven in large part by the tech sector and Mag 7, which have less sensitivity to the war. We also noted, based on our transcript reading, that companies are in the early days of understanding the ripple effects of the war, and some have buffers through inventories and hedges that may last a few quarters or 6 months. We suggested it might not be until the July-August reporting season companies can credibly adjust numbers. We continue to keep an eye on company commentary on the war in last week's transcripts, and would now add that several emphasized the difficulties associated with forecasting the impacts. Some were starting to adjust their fuel and cost assumptions, and some did adjust guidance. That makes us more open to the idea we could start to see some changes starting in April, but we continue to believe it will just take more time for companies to understand the impacts and what they will end up being. Third, on what else jumps out, we're also keeping an eye on US GDP forecasts. Last week, we got a few questions about the potential hit to economic growth from the conflict. We discussed what kind of reduction in the GDP outlook would be needed to trip up the US equity market in a profound way. We think adjustments would need to be major, not modest. Quarterly real GDP on a year-over-year basis in the 2.1 to 3% range tends to be associated with a strong equity market and S&P 500 returns of slightly more than 10% over the same 12-month time period. That's in line with the consensus expectation for GDP as the war began. Going one level down in the 1.1 to 2% range, the average S&P return falls to a bit less than 6% on the positive side. 2 levels down, when GDP falls to the 0.1 to 1% range, the average S&P return turns negative. And finally, last week's funds flows point to de-risking in equities. The latest weekly update from EPFR pointed to outflows from U.S. equity funds. This was not that surprising to us, as we've seen other weeks of outflows from this category in early 26. What jumped out to us even more, though, was that we saw outflows from European equity funds, global equity funds, and within the U.S. equity category, growth and value and blend. We also noticed sharp deterioration in flows to LATAM and EM. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.